In this example video, we're going to be looking at sales transactions for a merchandising business. Before we get into our example, let's look at some important reminders. When credit terms are offered, the accounts receivable and the sales accounts are going to be recorded at their net price value, which is our sales price minus that discount that is being offered. Again, credit terms are something like 210 net 30, 115 net 45. That means that the business is offering their customer a discount for paying sooner. For every sale under perpetual inventory system, there are going to be two journal entries. One that's going to record the sales price, and the second to record the cost of the goods that we are in fact selling to our customer. For every return, there are also two journal entries, one to record the refund that we're going to give to our customer, the second to record the increase to our inventory account because that is what we are getting back from our customer. If the shipping terms are FOB destination, when the company has to pay a credit card servicing fee, these are all considered expenses to the business, and it's part of just running and operating the company. So now let's get into our example. So in this example, they're giving us 5 different transactions that they want us to record, and in these 5 transactions, we are the seller in the situation. So in the first one, they tell us that we sold merchandise for cash for $25,000. The cost of the goods sold was $17,500. So again, every time that we have a sale, we have to record 2 journal entries. One to record the sales price, the second to record the cost to us as the company. Again, we're a merchandising business, so we have to spend money in order to make money. We have to purchase merchandise that we then turn around and sell to our customers. So they tell us that we sold this to customers who paid cash. So we know cash is our asset. It's increasing, so we debit our cash for $25,000. And the reason that we're getting $25,000 in cash is because we've made a sale. So we credit our revenue account, our sales account, because it is increasing as well by that $25,000. That's not pure profit to us because we actually had to buy the inventory that we turned around and just sold to our customer for $25,000. So we have our cost of goods sold account. This is an expense account, how much it cost me to purchase the goods that I just sold. And they told us it cost us $17,500. And the goods that we are selling is our inventory. So our asset account decreases by the $17,500. In the second transaction, they tell us that we sold merchandise on account for $98,000. The cost of the goods sold was $58,800. So they are telling us that we sold it on account, so we know that it's not cash that's going to be involved, but rather accounts receivable, which is that holding place for cash. There were no credit terms that were stated here, so we're going to record it at the full $98,000 value. And the reason why we're going to be receiving $98,000 sometime in the future is because we have in fact earned it. We have generated revenue for our business. We made a sale to our customer. Again, this is not pure profit for us, so we also have to record the cost. And they told us that the cost for this sale was $58,800, and what we are in fact selling is our inventory of $58,800. In the third transaction, it says we sold merchandise to customers who used MasterCard and Visa in the total of $475,000. The cost of the goods sold were $280,000. Anytime that a credit card is being used, MasterCard, Visa, American Express, Discover, any of those are seen as a cash transaction to us as the business because MasterCard or Visa or American Express is going to pay us the money, and then the customer then owes that money to MasterCard or Visa. They don't owe it to us. So we're going to record this as a cash transaction. So we are going to be receiving $475,000, Again, the reason why we've received that money is because we have in fact earned it. We have sold some of our inventory to our customers. We have to have that second journal entry to record our cost of our goods sold. And they told us in this example, it cost us $280,000 to purchase the inventory that we just sold for $475,000. And our inventory account decreases by the $280,000. In the fourth transaction, it says we sold merchandise to customers who used American Express for $63,000. Cost of the goods sold was $39,000. Again, regardless of the credit card that's being used, it's still seen as a cash transaction for us. So again, we have our cash of our $63,000 and our revenue account increasing by that $63,000 because in fact earned that $63,000 by selling our inventory to our customer. And of course, we have to record our cost of goods sold for the $39,000. And our inventory decreases by that $39,000 as well. And in the final transaction, it says we received an invoice from National Clearinghouse Credit Company for $13,450, representing a service fee paid for processing MasterCard, Visa, and American Express sales. So we got the invoice and it says that we've paid it. So this is an expense to our business. By accepting credit cards, that actually opens up a much wider range of customers for us. And by doing that, we unfortunately have to pay a fee for those credit cards to be processed. So we have a credit card expense for the total of $13,450, and they told us that the invoice in fact had been paid. So we pay those invoices in cash for $13,450.